Ever wondered what short selling is and how it works? Today, we're diving into the fascinating world of finance and tackling this intriguing concept. Imagine a scenario where you believe the price of a certain security, let's say a stock, is going to go down. You're so confident in your prediction that you decide to bet on this outcome. But how can you make money from a stock price going down? This, my friends, is where short selling comes into play. In the simplest terms, short selling is the practice of selling securities that you do not actually own, with the hope of buying them back at a lower price in the future. It's like borrowing a friend's bicycle, selling it, and then buying it back when bicycles are on sale to return it to your friend. However, short selling is not a practice undertaken lightly. Traders who indulge in this are essentially betting on the decline of a security's price. If their prediction comes true, they can buy back the security at a lower price, return it to the lender, and pocket the difference. But what happens if their prediction doesn't come true? Well, this is where the risk factor comes in. If the price of the security rises instead of falls, the trader is susceptible to incurring significant losses. They would need to buy back the security at a higher price to return it to the lender, thus losing money in the process. There are also two types of short selling, covered and naked. In covered short selling, the trader has borrowed the securities before selling them, much like our bicycle example earlier. Naked short selling, on the other hand, is a bit more complex and risky. It involves selling securities without actually borrowing them or ensuring they can be borrowed. Regulatory bodies like the Securities and Exchange Commission in the United States require short sellers to borrow the securities before selling them. They also expect short sellers to disclose their positions, information which is then made available to the public. In summary, short selling is a financial practice of selling a borrowed security with the expectation of buying it back at a lower price. Traders use it to capitalize on declining prices, but it's a risky strategy that could lead to significant losses. Whether you're an investor, a trader, or simply a curious mind, understanding concepts like short selling can provide valuable insights into the complex and dynamic world of finance. So the next time you hear about short selling in the news or in a conversation, you'll know exactly what it means. Thank you for spending these 7 minutes with us. Stay tuned for more insights into the world of finance.